Hey guys, how are you all doing? So Dan from Trading with Dan here. So in this video we're going to look at how to understand price action. So what is price action? Some traders will define price action merely as candlestick analysis. Other traders will view it as chart patterns, so the pictures in the chart that the candlestick analysis, basically the candlesticks will paint. We look at price action as the fundamental force behind market action. So understanding price action, we believe, is a trading skill developed through practice and experience over time. And to us, price action is the behavioral analysis of market psychology. So price action and market structure. So price action is defined as market movement that defines the market structure. Market structure is a record of how price action reacted in the past. We read price action through the lens of the market structure. Understanding price action means understanding the market psychology behind the market structure, and it is produced by the market movement. Right, so how do we analyze price action? When analyzing price action, we have to look at the following: how the market reacted after a large movement in one direction. Are the sellers or the buyers more aggressive? What happened when the buying and selling pressure relaxes? How the market reacts after testing support and resistance levels, and where actually are those support and resistance levels? So price action trading is not pattern trading. General market price movements are usually random. This in calculus is known as Brownian motion. The patterns of these movements create is also often random. So understanding market psychology and how traders react to these random price movements is a key to gaining a trading edge. Price action traders are not trading patterns, they are trading the market psychology behind the patterns. Price action traders are betting on the odds of how general market psychology perceives the random movements and not the actual random movements themselves. So when market is in equilibrium, market tends to equilibrium. Price drifts around a midpoint, and this is a phase in the market that technical traders will often avoid. Price action traders can obviously trade markets in this state because they understand the underlying dynamics of a market equilibrium and what traders are thinking at various points in time. So we can see various aspects going on here. We've got the center. So this is basically the center part of the midpoint of the overall price movement. We've got some failures here to get higher, some swing failure patterns to get above here. We've got some candlestick analysis that shows us we've hit this bottom here, and this level then becomes important going through. You can see that the trapping traders, as we're going up at this point, we've got we've got a lower high, a higher high, a lower low, and these traders thought we're going to get a higher high as we broke up towards here, but we didn't, so they're trapped in their longs. We move back down, back below the center value, and then back to our support zone. We then have another move up. We actually have the other move up that these guys thought was going to happen. We then have a climax failure, and then we retrace from there and just tend to equilibrium. So all this time not a lot is going on, but if you can understand what traders are thinking, what they're looking at, how they are perceiving this random movement, you can then predict what they're going to do, where the market's going to go, how the market is going to trap them and squeeze them. So eventually the market imbalance will end, and an impulsive move can start the end of the imbalance, that is. Traders may try to restore the balance. The market can then trend, and this entices in technical traders. So if we can see here, this is anti-equilibrium. This is a market that isn't in equilibrium. So you can see here we get a sudden spike on the lower time frame, so this then causes this rally up, this sudden boost of momentum. So we're getting a lot of one-sided buying pressure. We then start to test these resistance levels and range, have a little bit of sideways action. We come back and test this support line, then have another push up, and then another push up, and then another push up, and then you can kind of see we start getting supported by this trend line. There's buying coming in at these levels, there's selling coming in trend once we get it to either horizontals or basically too far away from the actual overall sort of trend line, and this is basically a market that is trending. So the interplay between equilibrium and imbalance. The interplay between the two is the fundamental essence of market structure. There is a route to understanding price action. So what this means is when we look at an market that's in equilibrium and a market that is in balance, obviously there's a fundamental difference to the underlying structure. There are more buyers, there are more sellers, and in balance the market's trending. And then in the state of equilibrium, there are not more buyers and not more sellers, and the price tends to just range around a level and not really go anywhere. So once you can ascertain which state the market is in, you will then have the context in which to understand the psychology of the market patterns. The patterns we see in the markets are a reflection of the market psychology, and we can use them to trade and define the risk.